Now, as a trustee, you have a number of duties and obligations to the beneficiaries. And again, if you are the sole beneficiary, there's really no one to enforce these obligations. Now, as a trustee, you have a great deal of control and discretion over the management and distribution of trust assets. And as a trustee, you owe a duty of loyalty to the trust beneficiaries. As such, you should try to avoid all conflicts of interest. Now, as part of this duty of loyalty, there should be no self-dealing. And one example might be where there's a valuable piece of real property held by the trust. You would be prohibited from selling it to yourself at a discount. Another example of self-dealing may arise where the trustee owns a construction company, maybe a general contractor, and there's trust property that's potentially, the parents' home they lived in for 40 years, may be dilapidated, may need significant remodeling before it can be sold or rented. So that general contractor who's also the trustee would be prohibited from providing those repairs at a premium. And as a trustee, they also have a duty to make good use of the trust property, make investments as a prudent investor would with investing his own money. Now, this is commonly referred to as the prudent investor rule. And unless waived by the beneficiaries, the trustee would have a duty to account, keep the beneficiaries reasonably informed of the trust administration process, and as mentioned previously, they'd be responsible for paying the income taxes and filing the tax returns. So I'd like to walk you through a sample trust administration. Here we have the Smith Family Trust created by George and Doris Smith. In this scenario, we have a $3 million estate consisting of real estate and liquid assets such as bank accounts and brokerage accounts. And in this scenario, George and Doris Smith have 3 children. Sally, never married and has no children. Bobby, 2 teenage children, and Susie, so it looks like 3 preteens. Now, under the provisions of the trust in this scenario, George and Doris Smith provided for a $100,000 gift to each of their 5 grandchildren, leaving the remaining assets in the residuary to be split equally among their children, Sally, Bobby, and Susie. Now, just a word of caution here to anyone on the line who may have a trust, thinking about putting together a trust, and may want to make some specific bequests to grandchildren or others. You want to be careful that you don't make so many specific bequests that there's nothing remaining in the residuary for the other beneficiary. So in this situation, we have here, $100,000 to 5 grandchildren and a $3 million estate. There's plenty of assets to pay the administrative expenses and for Sally, Bobby, and Susie to take home at the end of the day. So assuming George Smith dies on September 10th, 2004, Doris would be the sole trustee at that point, unless she was incapacitated, or we had an individual trust here for George and we needed maybe an independent trustee to act. But otherwise, Doris would be the sole trustee, and she would need to go back to the trust agreement at this time, review it, see if any distributions are required at the death of her husband George, and she may have to allocate George's 1/2 of the trust estate to a bypass trust to ensure those assets are not subject to estate taxes 1 year later when she ultimately passes away. Now, for a broader discussion of a bypass trust and some of these vehicles and tools we have to shelter assets from estate tax, feel free to contact myself or Jim and Debbie for a more in-depth discussion of those techniques. Now, September 10th, 2015, 1 year later, Doris is no longer with us, so the successor trustee needs to again review the trust provisions, take a look at the distribution guidelines. Are the grandchildren's gifts an outright distribution to be managed by their parents? Or are the gifts to be held in trust until they reach a particular age? Are they staggered distributions? Commonly, we'll split it up by thirds, a third at 25, a third at 30, and a third at 35. So if, maybe Jordan or Madison are not mature enough to handle the assets at 25, at least, George and Doris know that, there's more money coming down the road when, the grandchildren haven't matured further. So, additionally, we need to check to see if there's any limitations should, Bobby Jr., Lucy, decide to, choose to live an alternative lifestyle or fail to adhere to the religious convictions of George and Doris. Oftentimes, we have the trust documents and the will reflect the philosophies and religious beliefs of the trust makers, and many times, we include guidelines to ensure that the beneficiaries are adhering to lifestyle standards. So, additionally, perhaps one of the young children are a special needs child. So we need to check to see whether the inheritance, may disqualify them from governmental benefits such as Social Security insurance or Medi-Cal. So, if they're receiving substantial benefits from the government, perhaps it makes sense to disclaim their share and maybe have the other beneficiaries to set up a special needs trust for that individual if it hasn't already been done so at that time. And again, before making any distributions, we need an inventory and appraisal of the trust estate and pay all administration and burial expenses. At that point, we can start to think about when the distributions should take place. And finally, we can file the tax returns. However, in a scenario where we may need to file a 706 and we may have some estate tax liability, we might want to file those returns and get a closing letter back from the IRS approving the tax return before making those final distributions. So at this point in the presentation, we'll go ahead and turn it over for any questions.
Yeah, great information, Justin. A lot of, as the audience can see, there's quite a number of things you need to be aware of and some important dates to pay attention to. And being a successor trustee, you can find yourself in a situation where it can get complex or complicated pretty quickly. In my example with my grandparents, it was relatively straightforward and simple. However, I did need to reach out and get some assistance from time to time. So, I have some questions here that I'm going to go ahead and jump into and ask Justin about those. But if anybody has any questions that a particular situation or something that we have mentioned during the webinar, and you want to go ahead and type those in, please feel free to do so. You should have a little question box in your GoToWebinar software that should be on your screen. So with that, so Justin, I'm going to go ahead and jump into some of my questions, and if any questions pop up, I'll head on over to those. So what do you do in the situation if somebody had created a trust and they didn't get around to retitling all of their assets, for example, a home?
Well, that's actually a really good question. And it really depends on the type of assets that the trust maker owns at their death. Now, where the total estate is worth less than $150,000 and consists, mostly of bank accounts, investments, and life insurance, those items can pass to the trust maker's heirs, surviving spouse and children, by simply having each of them sign and present what is referred to as a small estate declaration. They present that to the various financial institutions, and they'll most likely cash them out if it's a bank account or transfer the assets to them. Now, if we're talking about real property, and the property was not retitled into the name of the trust, we can still avoid probate so long as the trust shows the trust maker intended for a particular parcel to be transferred to the trust. Now, this is usually done by listing the real property and a schedule on the back of the trust. Alternatively, if the fair market value of the property is less than $150, we can also avoid going through probate. But under both of these scenarios, we'd still need to petition the court for an order transferring the property to the beneficiaries.
Great. So that just gives us an idea that there is something to do, but it also highlights to the trust makers the importance of actually implementing all of their wishes and desires in their estate plan. So at this point, I'm going to note that it is 12:59. We're supposed to conclude here at 1 o'clock. I have one additional question that I want to go ahead and answer, but if you all need to go, then my feelings won't be hurt if I start seeing names drop off. And of course, we'll definitely have this up on the website for replay. This second half of the webinar today will be available for replay. And so if you can't listen to the questions now, feel free to listen to them at some time later, or you can give Justin or Jim and myself a call. So with that, one of the questions and something that I am asked regularly are, do the successor trustees or the executors, do they get paid for doing all this work?
That's actually a really good question as well, and again, it depends. So oftentimes the successor trustee is not compensated for the time they spend administering the trust. Now that's the case usually when you have the trustee who's also a beneficiary, and maybe the only asset in the trust is a home. So they could retitle the home and transfer it out to the beneficiaries. However, generally, trustee compensation is provided for in the trust instrument. Generally, it says reasonable compensation, or the estate planning attorney may have had a discussion with the trust makers. They may have set aside a flat fee or a percentage. However, if there is a lot of work required, an extraordinary effort, the trustee could petition the court. This is especially true when we have a court accounting. So there's a little, if it's a complicated trust, complicated administration, they can seek court approval of the accounting, and that's a good time to ask for trustee compensation. Now the court may fix or allot greater or lesser compensation depending on the work that was involved. But generally, a good rule of thumb used by corporate trustees here in California is about 1% of the balance of the trust assets at the end of each year.
Okay, good information. And I do see that I have one question here from the audience. And the question is, can a successor trustee borrow money from the trust, and what action should the beneficiaries take if the successor trustee refuses to pay the money back?
Well, that is actually a really good question, because first of all, we have a conflict of interest here, because the successor trustee is using trust assets for their own benefit. So if we have
technically they're not supposed to.
Well, the general rule
right?
of thumb is no, they're not supposed to, because it's a conflict of interest and they have a duty of loyalty to the beneficiaries. Now, you would need to look at the trust instrument to see if it provides that type of discretion to the trustee.
Okay.
If it looks like they borrowed the money, they're not paying it back, the beneficiaries have the right to petition the court for an accounting. And if the trustee has not paid back the trust at that time, the beneficiaries can also ask that the trustee be removed if it's deemed a breach of their fiduciary duty to the beneficiaries. I think you really have to look at what the amount is that the trustee has borrowed, and to see if it outweighs the potential attorney's fees and court costs involved.
Right. Okay. Good. Hopefully that answered the question. If not, please type something additional in and let me know if you have additional questions on that, or you can obviously contact Justin to find out more detailed information about a specific situation. So, okay, so last question that I have is how much does it cost, and how much does it, what's a typical cost involved in settling a trust, and, and typically how long does it take?
Trust administration is different. So, we were talking a little bit earlier about a simple trust, it has a home. You might pay a small filing fee to retitle the house, and if you hired an attorney to prepare the grant deed, probably a few $100s. If we're talking about more extensive work, such as providing an accounting to the beneficiaries, and we have distribution guidelines that may require legal assistance to make sure they're carried out, it could be anywhere from $2,500 to $5,000 for trust administration, and the cost of administration would go up from there if court involvement was required. Kind of like in the question from that we just received, if it does require the trustee to defend a court action, that obviously would increase the cost involved in administering the trust.
Yeah, obvious. Yeah, that makes sense. One question that occurs to me, is there anything that a successor trustee can do to ensure they have identified all of the assets? It would be nice to think that trust makers have all their papers in order and everything's orderly and easy to identify. But if in the case where that's not the situation, are there things that can be done to help identify assets that might be out there that they may not be aware of?
Yes, there is. I actually work with an attorney here in the local area who is also a private investigator, and he can run an asset search. I don't think you have to be a private investigator to do so, but you can do an asset search based on the Social Security number, and you can pull up all of the bank accounts and financial institutions that have that Social Security number registered and holding assets.
Okay, and so that's not something that someone can do on their own. Rather, you have to go to somebody who has access to such a database?
Right. You really need a professional to do that. If you really want an extensive search undertaken, you need to hire a professional. And the fee is really not that much. I think it's probably $300 to do a complete asset search.
Okay. Okay. Probably well worthwhile if you suspect there are other accounts out there.
Sure.
Okay. Well, Justin, great. That is all the questions that I have for you today. It doesn't look like we have any other questions in the queue. So I really appreciate your time and the great information you shared. So thank you very much for being with us here today. And I hope all the clients on the call found it worthwhile. I'll look forward to talking to you all soon. And thank you very much for joining us today.
Thank you, Debbie.
Thank you for attending this afternoon. I hope you found the information presented helpful. Just a reminder, as Debbie noted, the webinar will be uploaded to our website for you to